Nigerian headline: inflation slowed for the fifth consecutive month in August 2025, providing some respite for consumers grappling with high living costs. Data released by National Bureau of Statistics shows that inflation dropped to 20.12%, down from 21.88% in July 2025. Welcome to Business Point, where we x-ray the Nigerian economy and the government policies. I am Kike Lomo Okeri. Nigeria headline inflation slowed for the fifth consecutive month in August 2025, providing some respite for consumers grappling with high cost of living. The figure represents a 1.76% point decline on a month-on-month basis and a sharp fall from the 32.15% recorded in August 2024. The Consumers Price Index, which tracked the average change in price of goods and services, inched up to 126.8% in August from 125.9 points in July. Month-on-month inflation stood at 0.74%, lower than 1.99% in July, pointing to a slower price increase across the country. The report reads that the Consumers Price Index rose to 126.8 in August 2025, reflecting a 0.9% increase from preceding month of 125.9 points in August 2025. The headline inflation rate eased to 20.12% relative to July 2025 headline rate of 21.88%. Looking at the movement, the August 2025 headline inflation rate shows a decrease of 1.76% compared to July 2025 headline inflation rate. The Statistics Office noted that inflationary pressure remains uneven. Urban inflation eased to 19.75% year-on-year in August from 34.58% a year earlier, while rural inflation was slightly higher to 20.28% compared to 29.95% in August 2024. On a monthly basis, inflation in urban areas slowed to 0.49% from 1.86% in July, while rural inflation came in at 1.38%, down from 2.30%. The figure underlined the sharper impact of inflation in rural communities, where transportation, distribution, and supply chains challenges continues to drive higher price growth than in urban center. Food inflation, which remains the strongest drive of Nigeria inflation basket, also moderated in August but stayed elevated. The index declined to 20% year-on-year from 37.52% in August 2024. On a month-on-month basis, all right, let's take a quick short break now. We'll be right back. Don't go away. Let's take a quick short break now. We'll be right with us. It was due to technical itch. Still on the inflation in the month of August, Looking at the movement, the August 2025 headline inflation rate shows a decrease of 1.76% compared to July 2025 headline inflation rate. The Statistics Office noted that inflationary pressure remains on. Urban inflation 19.75% year-on-year in August from 34.58% a year earlier, while rural inflation was slightly higher at 20.28% compared with 29.95% in August 2024. On a monthly basis, inflation in urban areas slowed to 0.49% from 1.86% in July, while rural inflation came in at 1.38%, down from 2.30%. The figure underlines the sharper impact of inflation in the rural communities where transportation, distribution, and supply chain challenges continue to drive higher growth than in urban city. Food inflation, which remains the strongest drive of Nigerians' inflation basket, also moderated in August but stayed elevated. The index declined to 21.87% year-on-year from 37.52% in August 2024. On a month-on-month basis, food inflation slowed 0.65% compared to 3.12% in July. The moderation was linked to falling price of staples including rice, guinea corn, flour, maize, millet, semolina, and soya milk. The 12-month average for food inflation stood at 25.75%, lower than 36.99% recorded the year earlier. Despite the improvements, food prices remain high, especially in the northern states, where insecurity and logistic bottlenecks have continued to disrupt supply chains. Core inflation, which excludes volatile agricultural products and energy, was recorded at 30.33% year-on-year in August, down from 27.58% in August 2024. However, the index rose on a monthly basis to 1.43% from 0.97% in July, reflecting pressures from categories such as housing, water, electricity, gas, transportation, education, and healthcare. The movement suggests that while headline inflation is easing, non-food inflationary pressure remains, raising concern for policymakers and monetary authorities who monitor core inflation closely as an indicator of structural pressures. Across the state, inflation trends remain mixed. Ekiti posted the high year-on-year headline inflation at 28.17%, followed by Kano at 27.27% and Oyo at 26.58%, while Zamfara at 11.82% and Anambra at 14.16% and Enugu at 14.20% recorded the lowest. Food inflation was highest in Borno at 36.67%, Kano at 30.44% and Akwa Ibom at 29.85%, while Zamfara at 3.30%, Yobe at 3.60% and Sokoto at 6.34% recorded the lowest. On a monthly basis, inflation rose fastest in Yobe at 9.20%, Katsina at 8.59% and Sokoto at 6.57%, while Enugu at minus 0.32%, Taraba at minus 3.64% and Nasarawa at minus 3.56% saw declines. The announcement of the inflation slowdown comes just days before Central Bank of Nigeria Monetary Policy Committee meeting scheduled for September 22 and 23, 2025. The committee is expected to deliberate on whether to maintain or adjust the current MPR at 27.5% benchmark interest rate, while 5 straight months of disinflation could give the bank some policy flexibility, the persistence of food and core inflation suggests that the MPC may remain cautious in its decision. The federal government has suspended the implementation of the 4% free on-board levy recently introduced by the Nigerian Customs Service on all imported goods. The decision announced by the Minister of Finance and Coordinating Minister of the Economy, Wale Edun, followed widespread concern from importers, trade experts and other stakeholders about levy negativity, economic implication. In a letter addressed to the General of Customs, Wale Edun, acting in his capacity as the chairman of the Nigerian Customs Service Board, ordered the immediate suspension of the levy. The letter, signed by the Permanent Secretary for Special Duties in the Ministry of Finance, Raymond Omachi, explained that extensive consultation had been held with stakeholders and experts, whose feedback shows that the levy would place a significant strain on trade and the economy. The letter stated that following extensive consultation with the industry stakeholders, trade experts and relevant government officials, it has become clear that the implementation of the levy poses significant challenges to trade facilitation, the business environment and overall economic stability. Stakeholders, particularly importers and business operators, had repeatedly warned that the levy would worsen inflation, increase cost of goods and weaken Nigerian trade competitiveness. Many argue that the charge will complicate efforts to ease the cost of doing business in the country. According to the ministry, the suspension aimed to create room for further engagement with all relevant stakeholders and a comprehensive review of levy framework and long-term impacts on the economy. Recall that in April 2025, the Comptroller General of Customs, Adewale Adeniyi, announced plans to reintroduce the 4% levy after consultation with stakeholders. The charge, calculated on the free on-board value of import, had previously been criticized by the business community for its heavy burden on the importers. The announcement immediately drew backlash from traders, shipping companies and manufacturing associations, who maintained that the move would erode investors' confidence and reduce Nigerian attractiveness as a trading hub. The Finance Ministry clarified that the suspension is not a cancellation, but a necessary pause to reassess the levy potential effects. The ministry emphasized the government's commitment to balancing revenue generation with economic growth. The government is expected to hold further discussion with stakeholders, including trade groups, freight forwarders and importers, to design a fairer system that does not overburden businesses. Analyst says this review period provides an opportunity for authorities to align custom policies with broader economic reforms aimed at stabilizing the naira, reduce inflation, and improve Nigeria's ease of doing business ranking. Members of the Monetary Policy Committee of the Central Bank of Nigeria have called for a coordinated and a whole of government approach to boost the nation's foreign direct investment. This was made in a personal statement of members of the Apex Bank ahead of the month's MPC meeting. According to the latest capital importation report released by the National Bureau of Statistics, foreign direct investment into Nigeria dropped sharply by 70.06%. quarter on quarter to $126.29 million in the first quarter of 2025, down from $421.88 million recorded in the final quarter of 2024. The steep decline in FDI occurs despite an overall increase in capital importation into the country, indicating foreign investors are favoring short-term, high-yield financial instruments over long-term productivity commitment in the Nigerian economy. One of the NPC meeting Aloy Odu, in his statement, lamented the decline, noting that it is lower than what other countries is bringing in. He says inflow of foreign direct investment amounted to $1 billion in 2024. According to the United Nations Center on Trade and Development, this amount is considerably lower than FDI flows to comparable countries like Indonesia with $24 billion, India with $28 billion, Egypt with $46 billion, and Brazil with $59 billion. During the same year, another member, Lydia Jafia, suggested that some of these FDIs were already coming in, especially into oil and gas sector. She says there is need to strengthen the positive real interest rate to align with global financial conditions, leading to improved capital flow and competitiveness. Afrivest has projected that Nigeria's recent success in curbing crude oil theft could ease pressure on the foreign exchange market, boosting fiscal revenue and strengthening investors' confidence in the oil and gas sector. In its latest microeconomic research, Afrivest cited data from the Nigerian Upstream Petroleum Regulatory Commission, which reveals that crude oil losses drop of to 9,600 barrels per day as of July 2025, the lowest level in 16 years since 8,500 barrels per day in 2009. This represents a 15% improvement from 2024 average of 11,300 barrels per day, a remarkable 90.7% decline compared to 102,900 barrels per day recorded in 2021. According to Afrivest, this turnaround can be attributed to reform introduced by the Petroleum Industry Act of 2021, alongside improved collaboration between regulators, security agencies, host communities, and industry operators. Measures such as metering audits across upstream facilities and stricter regulators' oversight were also credited for plunging revenue leakages. The research firm noted that the reduction in oil theft could provide fiscal relief at a time when government finances are under strain. Despite ongoing disparity between the actual crude production level and the federal government bank budget benchmark, with a production standing at 1.51 million barrels per day in July against the 2025 budget target of 2.01 million barrels per day. Reduced theft means more crude is available for export, translating into increased revenue for Federation Account Allocation Committee. Afrivest also stressed the foreign exchange benefit, pointing out that the crude oil export accounts for 85% of the Nigerian FX earning. The report stated that higher export volume stemming from reduced crude oil losses should result in the improved FX liquidity and external reserve, thereby easing pressure on the Naira. All right, let's take a quick short break now. We'll be right back. Don't go away. Stay with us. Welcome back. If you're just joining us, it's Business Point, where we x-ray the Nigerian economy and the government policies. The Nigerian Naira on Monday appreciated against the United States dollar, trading below 1,500 Naira to a dollar threshold for the first time in over 6 months. Data from the Central Bank of Nigeria shows that the domestic currency closed at 1,497 naira to $1, compared to its previous close of 1,501 naira to $1, marking a 0.27% gain. The last time the naira traded below 1,500 naira to $1 level in the official market was February 2024 and March 4, 2025. The recovery comes after a week in which the naira repeatedly tested the 1,500 naira to $1 mark, posting its lowest intraday rate just above the threshold. The positive momentum was also mirrored into the parallel markets, where the naira strengthened by 0.33% to settle at 1,535 naira to $1. According to data from the Cardinal Stone Research, market reports indicate that the naira gained 0.98% week on week to close at 1,501 naira to $1 in the official window, while the parallel market fell by 0.33% to 1,535 naira to $1. According to the Coronation Weekly Update, the official exchange rate ended the week at 35.50 naira, that is 2.23% premium to the parallel market rate, suggesting a narrow gap between both markets. The update also shows that the total foreign exchange inflow into Nigeria rose to $550.90 million last week, slightly lower than the $567.20 million recorded in the previous week. Foreign portfolio investment dominated the inflow, accounting for $303.8 million, that is 55.15%. Exporters contributed 17.61%, non-bank corporates with 17.57%, and other corporates 4.32%. Foreign direct investment with 3.39%, the CBN 2.36%, and individuals 0.60%. Analyst says currency appreciation has been largely supported by strong foreign portfolio inflow, healthy external reserve, and continued policy intervention by the Central Bank of Nigeria. The FX market is expected to maintain its current stability, supported by the CBN, continued policy adjustment, and fiscal efforts to ensure adequate liquidity. The Nigerian Oil Share Index closed the trading session of 15th September 2025 on a positive note, adding 1,113.31 points to settle at 141,659.0 points. This marked a 0.79% gain from the previous close of 140,545.69 points, kicking off the week on a strong footing. Trading activities also pick up a marginal market. Volume rose to 555.1 million shares, up from 434 million shares recorded in the prior session. Likewise, the market capitalization advanced from 88.92 trillion naira to 89.62 trillion naira. All right, this is where we draw the curtain on Business Point today. Join me again tomorrow on Global Television, channel 365 on DSTV and 276 on terrestrial Star Times. To stay connected, kindly follow us on all our social media platforms at Global TV NG. Till I come your way again, I am Kike Lomo Okeri. I celebrate you all.